let's talk some indicators and technicals with John Kosar, Chief Market Strategist at Asbury Research, some of the Asbury 6 that we check in on almost, I guess, monthly. John, good to see you again. And I see a lot of red on your analysis, so take us through it, because this is a pretty distinct change.
Sure. The last time I was with you was on the 17th of July. On the 24th, the Asbury 6 turned to negative. And what that means, 4 or more of the 6 constituent indicators turned red or turned negative, or turned bearish, let's call it. And it has remained there since. The S&P 500 initially declined by 6% following the change in the A6. And as you can see, well, as we can see now, 5 of the 6 are still red. So looking behind the A6 a little bit, there are 4 of those. I can't rattle off which 4 there are, but there are 4 more of these that very easily could turn back to green by the end of the week. But this is a really big, one expression I like to use is knowing that the market is at an important tactical decision point is the next thing to knowing what the market's going to do a week from now, which nobody knows. And we're at that point now. We're at that specific point now where this is a big inflection point. You can see it in the Asbury 6. I can see it all over the place.
So the VIX part, John, that's still positive. Take me to that and walk us through what that means.
Sure. The last time I was with you again on the 17th, I always go back and look and see what I said last time. So we have, kind of a, we have a through line. The last time I was with you, I said the only one of the Asbury 6 that was negative, it was the VIX. And, a week later, the Asbury 6 turned and, the market fell into the lows. So now the VIX is edging back down through its 21-day moving average. We have a chart for that we could look at. But I use a 21-day overlay on the VIX to let me know if the trend is towards higher fear, more fear, or less fear. And right now, it's just edging through that 21-day moving average. That level, by the way, on the close yesterday was 1964 in the VIX. So that's something I'm watching really closely. So we could see we've got the VIX. You can see it's just edging right through in the bottom panel, just starting to get through there. So one of two things could happen. It could stay underneath there, and it's going to be conducive to the market going higher over a tactical time period. For us, it's about a month. If the VIX suddenly jumps back up above there, however, that means the market's getting spooked, and we could look for more weakness here coming up. I know there's still some numbers coming out. We have some important earnings reports coming out this week, but this is a really, I don't want to overstate this, but this is a really big tactical level for the market. 54.50 is our resistance level. We traded as high as 54.48 so far this morning. It looks like the market saw it, and we've at least had a little bit of a recognition of that, but that's what we're watching.
The VIX part is kind of being the only positive indicator, and yours to me is like the least comforting one to have as a positive indicator, because basically it's moving below that moving average because it spiked so huge and came down so fast, right? So still nominally it's elevated.
Yeah, and it's the spookiest of the indicators. I mean, it doesn't take a whole lot to get that to jump. So it tends to be more sensitive than the others. But those others, like I'm looking at the, the third one down, the investor asset flows. I don't have a chart for you on that today, but I literally looked at it 5 minutes ago. And 1 or 2 more days of asset expansion in SPY, and now we're back to a monthly expansion in those assets, which is shares outstanding multiplied by NAV. So it's kind of like, buckle up here. What happens between now and Friday, I think, is going to dictate where the market goes on its next tactical move that'll take us into September.
All right. Okay, so at least half of your indicators have been red basically since August 1st. now that it kind of goes a majority red, we should be on alert. Tomorrow, as you mentioned, we've got big data that'll talk to us about the economy. In the meantime, it seems like your sector analysis points towards kind of traditional safety style sectors as having the best relative strength. Is that fair? Like utilities, healthcare, what else is in there? Real estate?
Yes. First utilities, second real estate, third is healthcare. We have a graphic on that if you want to put that up. But those are the three. 203 of those are seen to be defensive sectors. And interestingly, the last time I was with you, utilities had just moved into one of the top 3 spots there, according to the ranking system, which is all the way to the right. It's based on asset flows in multiple timeframes. And XLU is still there. And since July the 14th, which is when the signal actually arrived, there it is. So here's July 14th. You can see up on top, the CEF model moved into a favored ranking. These are the rainbow charts that accompany the CEF model for our subscribers. And in that period, down here in the lower panel, we have XLU versus SPY, which is the S&P 500, of course. So it's outperformed by 14% since it's gone into favored territory. And look how high it is up in favorite territory. That means it's a very, very low score according to the CEF model, which means there's a lot of money moving into that space in multiple time periods.
Okay. So looking like it's been in the works for a couple of weeks, kind of building up some momentum here. Really great stuff. Always appreciate the charts and the update on the model as it comes in. Thanks, John.
Great to see you. Thanks.